Tom, we just heard Dom talking. Sometimes we get taken with the mega cap or big cap bank names. Are those the place to be, or some of those regionals perhaps offer a better opportunity right now, in your opinion?
So we think that last year was the year of the universal bank stock, and that they were performing better than the typical spread lenders and regional banks. And we think there are forces, we just heard what was said from Dom, that we think are absolutely true. But we think the benefit's going to be better in the regional banks and the banks that are more spread dependent, because they're the factors that caused us to be bullish on the bank stocks, which are improving loan growth as well as higher rates, taking off some of the pressure of zero interest rates, are happening sooner and probably to a larger degree than we even anticipated when we upgraded the sector last September. So we think that banks that this year will probably be the year of the more spread dependent banks. And just to give you a statistic, David, the regional banks trade at around 65% of the relative market multiple. The last time the Fed went through a rate increasing cycle from over 9 times end of 15 into 18, the relative multiple average was 91% to the overall market. So our view is that the underlying fundamentals that we're talking about with rates and improving loan growth probably mean that bank earnings estimates are too low. You could see estimates go higher, and the stocks are still trading at a pretty big valuation gap.
All right. So to dig in a little bit on that, over the time that the Fed is raising rates, that entire period, the banks are starting to re-rate, or you expect them to?
Well, I think certainly at the launch period. We're in the launch period. Now the Fed can go too far, and I think the market could get into that dialogue, but we are well away from that point. And remember, we're coming off of zero, essentially. So the fact of the matter is, we think there's a long way to go for this rate impact to impact the income statements of banks. And so we think that we could be in for a pattern of increasingly higher earnings estimates. And really what we think is you go into 2023, really good earnings momentum, which is something on a core basis, which is something that you hadn't seen. I mean, the banks outperformed last year, I think, because they really performed well during the recovery trade. It wasn't really an core earnings growth story yet. And that's what we're starting to see right now. And I think that's when we talk about the fourth quarter earnings, which start on Friday, with JP Morgan coming up next week, is that, we think that that's what's going to be talked about.
Tom, it's Morgan. So we can talk about rising rates. We can talk about net interest margin. How do you balance that against housing and loan growth, for example, given the fact that the Fed is tapering things like mortgage-backed securities purchases, and you do have those multiple rates expected this year, which presumably could have an impact on some of that lending activity?
So, well, the lending. So really, we think the driver for the lending activity is going to be economic growth. And also what's unusual this time, we almost never have the stimulus that we just had. And remember that PPP program? The government was willing to step in the place of banks and make loans during the pandemic. As that comes off, and that is really a theme for this year, is that that's all coming to an end. Now the private sector, the banking industry, is going to get a chance to step up. And that's what you're seeing in the Fed weekly data. And that's what we're hearing from the managements. And so that's part of we think that the loan growth story is actually part of the bullish story. It was a positive surprise in the third quarter, and we think it's likely to be a positive surprise again in the fourth quarter.
Shepard Smith here. Thanks for watching CNBC on YouTube.